Assalamualaikum and hi everyone. Here, our group will present about the normal distribution of financial accounting ratios as indicators of business status. What is financial ratio? Financial ratio is a comparison of two numerical numbers obtained from an enterprise financial statements. There are many types of financial ratio. The first one is activity ratios. Activity ratios is a type of financial metric that demonstrates how proficiently an organization is utilizing the resources on its asset report to create money and incomes. The second one is liquidity ratios. Liquidity ratios is a financial ratio that used to figure out an organization's capacity to pay its transaction obligation commitments. There are three types of liquidity ratio, which are current ratio, quick ratio, and cash ratio. Next is investor ratio. Investor ratio is when an investor evaluates a company based on its ability to produce a return for their investment. Last but not least is the distribution of financial ratio. It is distasteful to expect that a bunch of financial ratios registers in a company's record. It is also sensible to accept the information if the companies set up their bookkeeping records to adjust to the standards, methodology, and declaration.
Distribution and skewness. It is used to understand the action of the ratios, and it's technically representing as frequency curve of an event, which is the financial ratio of beta from PLC. And the shape of curve should be skewness. Normal distribution consists of three characteristics. First of all is a mean, median, and mode match at the center of distribution. The second one is on the specifically, it is exclusively determined by its mean and standard deviation. And the third one is a symmetrical about the mean due to perfect symmetry. So in this case, we use the normothetic method is used to analyze secondary data on financial ratio produced. The normal distribution method is applied as a basis for the research plans. Here are the formula of the normal distribution and the normal distribution curve skewness.
Greetings to Doctor and to my fellow friends. So now I am going to talk about rules to determine the normality in the result part, whereby the first rule talks about the moment of ratio test, the second part it talks about moment coefficient of skewness, and the third condition it states about the moment coefficient of kurtosis. Whereby we know that all the financial ratios in the article provided are normally distributed and most of them are platykurtic. Platykurtic meaning they have thinner tails and a normal distribution leading to less extreme positive or negative events. And we know that our null hypothesis has been rejected. These are the formulas to find the ratio. The first one, debt equity ratio, debt over equity. The second, proprietary ratio, proprietary funds over total assets times 100. Third, stock turnover ratio, cost of goods sold, average stock. And the last one is asset turnover, net sales or average total asset. That's all from me. Thank you.
For the results in margin on sales, we use profit margin formula to find the ratio, which is net income over the annual sales times 100%. Then gross ratio is net profit over total equity plus non-current liabilities times 100%. The third one is current ratio, which is current assets over current liabilities. And the last one, in acid test ratio, we use quick ratio formula, which is liquid assets over current liabilities.
Now, I will present for conclusion. Financial ratio are mathematical comparison of financial statement accounts. Financial ratio can be an important tool for small business owner and manager to measure their progress toward reaching company goals. This relationship between the financial statement account help inventors and internal company management to understand how well a business is performing. Traders can use the standard deviation to suggest potential trades. Many statistical theories attempt to model asset prices under the assumption that they follow normal distribution. Even if an asset has gone through a long period where it fixes a normal distribution, there is no guarantee that the past performance truly informs the future prospects. Thank you.